off from the discussion, from the papers that we see. One would be where you give gold, you get some interest, and you receive back gold at the end of the period. And the second will be where you give gold, you get some interest, and in the maturity date, you get back money. So there seem to be two kinds of schemes, and we will see how they actually unfold. Section 6 of the Income Tax Act is proposed to be amended. This doesn't relate directly to hotels, but it can be relevant because there are many Indian companies now which are setting up subsidiaries, or under the LRS, the Liberalized Remittance Scheme. You know that even individuals are allowed to remit out up to $250,000 per financial year. When people want to buy an apartment, for instance, in London, then they do not quite often want it in their own personal name, because there is estate duty in the UK, and also when they transfer there would be higher stamp duties and so on. And also there would have been wealth tax if they held a second property in their name outside India. So many times a person would form a company. Now this can be relevant not only for properties but even for your business companies if you set up a subsidiary outside India. Section 6 of the Income Tax Act says that if a company is incorporated outside India, normally it will be treated as a non-resident company. But in certain cases, an overseas company can be deemed to be resident of India. It is deemed to be resident of India if the control and management is wholly exercised in India. Therefore, if you have shares of a company outside India, you must ensure that the management takes place outside India. Even though both the directors may be in India, it may be your own company subsidiary, do not have board meetings here. You must go outside India and have the meetings there, so that you can show that the control and management is outside India. But that test is now being changed, and it's going to be more subjective and more stringent, because now they will say that a foreign company will be resident of India if its place of effective management at any time in that year is in India. And the place of effective management means a place where key management and commercial decisions that are necessary for the conduct of the business of an entity as a whole are in substance made. So for instance, if a large hotel company, the Taj for example, or the Oberoi Group, has a subsidiary outside, they have a hotel in New York for instance, and suppose they decide, well, we want to sell that hotel there, or we want to buy another hotel, or we want to revamp it, let's undertake a program for restoration or refurbishment, we'll keep it closed for 6 months, and they take a decision here, then it could be said that the key decision making is done in India, and therefore the foreign company, which is a subsidiary of the Indian company, is resident of India, and therefore all the income of that foreign company will be taxable in India because it's resident of India. So you have to be very careful, and if you do have a subsidiary outside India, whether it's for business or for property or for hotels or anything, then just ensure that no decision making takes place here. Everything should be done outside India. Communications have to be minimized. If you are on the board of that company, do not even participate telephonically or by video. Go outside India. Even if you don't want to go all the way to America, go to Dubai and participate from there, but not from India, because this is going to make it much, much more difficult. Section 195 of the Income Tax Act already provides that any payments to a non-resident are subject to deduction of tax and source. So suppose you're buying an apartment from your next door neighbor, and you have to pay him 1 crore of rupees. Now he may himself have bought it for 90 lakhs of rupees, and now he's selling it, he doesn't need it. So you know from his own documents that his gain is only 10 lakhs. Or he may have bought it for 1 crore 20 lakhs, and now he's selling it at a loss. So you know that he's made a loss. But when you're paying him 1 crore of rupees, you have to deduct tax on that crore as if that entire crore was income. And if he had bought his property less than 3 years ago, then it's a short-term capital gain or a short-term holding. You would have to deduct 33 or 34% on that 1 crore of rupees, even though he has no tax liability. So that provision is already there, so you have to be extremely careful when you're dealing with a non-resident and making any payments to a non-resident. But now they say that the payer also has to give information to the income tax department. That means you have to be careful in your dealings with the non-resident, and you also have to inform the income tax department every time you deduct tax and make payment to a non-resident. Section 271I will say that if you do not give such information pursuant to your deductions under Section 195, then there will be a penalty on you of 1 lakh of rupees. This provides that the withholding tax on payments of royalty or technical know-how fees to an overseas party will be reduced from 25% to 10%. Many hotels have collaborations. Many times you will get technical know-how fees. You will pay technical know-how fees, say to architects or to interior decorators, or if you have to pay to other consultants outside India. Many times persons outside India say that we want the payment to be made to us net of tax. We do not want to get involved in Indian tax. So if you have to pay us 10 lakhs of rupees, well, you work out the Indian tax and you pay that. And we want that 10 lakhs net. Now, fortunately, the rate of tax on this will come down from 25% to 10%, so that means your liability will be a little bit less. Last year, the finance minister talked about REITs, real estate investment trusts, and other investment trusts. Those, not much work has been done on those. Some work has been done. SEBI has come out with rules relating to REITs and invites, as they call them, but still those have not really got off the ground. Now, however, they have said that an investment through a REIT will be treated as a pass-through investment, and therefore the REIT itself will not be subject to tax, but you as the investor would be subject to tax, so there will be no double tax. There will be only a 1-point tax in the hands of the investor. So if the investor makes a long-term capital gain, then he'll have the same facilities as he would have in respect of any other investments. Likewise, there will be no TDS on the REIT itself. So if you invest in a real estate investment trust, which buys property and leases it out and earns rental income, then there will be no TDS at that level. But the REIT will work out the amount which it has to pay you, and you will treat that as your rental income or your capital gain, as the case may be. There is a small amendment to the provisions relating to depreciation, Section 32 of the Income Tax Act. But I find that it is not clear. So this slide and the next one cover that. The provision now is that if you buy an asset, if you put an asset to use less than 180 days before the end of the financial year, that means from about October 3rd onwards, then you get depreciation at half the regular rate. So if your normal rate of depreciation is 20%, you'll get only 10% in that first year, which is fine. We've got used to it. Now, however, they want to give a benefit. But I think that the language of the benefit is not clear. They say that in the first year, in year 1, you will get a deduction of half. So if your asset cost 100, your depreciation would have been 20 because you bought it in the latter part of the year, you get depreciation only of 10. Now normally your written down value would have been 90, and next year you'd have got 20% off that 90, 18 would have been your depreciation deduction. But the way that they've done it now is unclear. So there are 3 different possibilities that there can be. The existing one is the first set of figures. Cost 100, depreciation for half year 10, opening written down value 90, depreciation at 20%, that's 18. But under the new law, it could be either of these two because it's not clear. One example would be that your opening written down value is 90, you get a brought forward allowance of 10, which you would have got if you had got it for the whole year, but since you didn't use it for the whole of year 1, now you're getting that 10 carried forward. So it'll become 90 minus 10, that means 80. That will be your written down value, and you'll get 16 out of that 80. So your total depreciation will be 10 plus 16, that is 26. Whereas the other calculation is if you reverse the figures and where you put the brought forward allowance down. So the second calculation could be that you get 90, you get depreciation at 20% on that 90, that's 18, and you get the brought down allowance of 10, so your total depreciation will be 28. Now the language doesn't indicate which of these two is going to be. I think they'll have to come out with a clarification. So this is intended to help, but in any case, one would have recouped the depreciation over a period of time. Now you will get it accelerated in the second year. Section 80JJAA has already been on the statute. This said that if you have a factory with more than 100 of at least 100 workmen, and you now employ more workmen for that factory, and if you are a company, then you will get a weighted deduction for the salary that you pay these additional workers. So suppose you employ 10 additional workers, and they are working for more than 300 days in a financial year each. Whatever you pay them, you'll get 30% extra, so you get an extra benefit from income tax, and you can save on some income tax. This year they've changed it to say that your threshold is not 100 workers, now it goes down to 50, so that helps. And it also says that you will get that it's not only a company that needs to be the employer, it can even be a partnership firm or a proprietary concern. But it still relates to factories. Now that again is not the right way. Hotels employ so many people. All your hotels employ 100 plus workers or people. If you get more persons in your company, in your hotel, or if you have an expansion, you are not going to get this kind of facility. It's only a factory that gets it. On the one hand, they increase the service tax because they say that the service sector is booming. It's growing more than the manufacturing sector. And then they don't give benefits to the service sector at all. So that's really very unfair because the growth is now not so much towards manufacturing in spite of all their efforts. It's in services, it's in hotels, it's in IT. The IT companies which have call centers have thousands and thousands of employees. But they are not going to get this kind of benefit. It's only a manufacturing company that will get it. So I think this is the kind of thing that you must represent on to say that when the finance minister himself has said that there will be a fund of 1,000 crores set up for encouraging entrepreneurship and recognizing talent, then that itself shows that the thrust is on entrepreneurship of any kind. Even if a person is just a trader, if he has more than 50 employees, then he is giving jobs. So therefore he should get this kind of facility. Section 92BA is another one which gives some relief to assessees. This provides for domestic transfer pricing. We have international transfer pricing which is very strict. If you have any transaction with an associated enterprise outside India, then the income tax department goes into in great detail. You have to have a transfer pricing audit. They have special transfer pricing auditors officers who look into this in great detail. And for domestic transfer pricing also this issue was going to come up. But the threshold here was 5 crores of rupees, which now they are raising to 20 crores of rupees. So if one of your companies deals with another of your companies, if your total transactions with associated enterprises are less than 20 crores, then you don't have to worry. Otherwise, you are going to be concerned with the DTP, domestic transfer pricing. Section 95 says that the GARD, the General Anti-Avoidance Rule, which was going to be extremely subjective and give the Income Tax Department the right to question every transaction as being motivated by tax considerations, that has now been pushed off for another 2 years, till assessment year 2018-19. And then a few years ago, perhaps you remember, Mr. Chidambaram had said that he would introduce a direct taxes code. The finance minister now says finally that that is dropped. We are going to continue with this regular income tax act, and of course there will be no wealth tax now. So this income tax act is going to stay. There are some other amendments. One relates to charitable trusts. Yoga is treated as a charitable purpose, and another one which would affect associations was this: that if an association, such as yours, for instance, had receipts of more than 25 lakhs from an activity which was considered a business activity, then it would have to pay tax. But now they say that if the income from the business activity is less than 20% of your total receipt, then you do not have to pay tax on that. But if your receipts are entirely for your activity, then you will have to continue to pay tax. Then we go on to the next one. Section 158AA is also a novel provision. This says that suppose you have a matter, an income tax appeal, and you succeeded before the commissioner. the Income Tax Department has the right to file an appeal to the tribunal. And usually they will do so. But if there is an identical matter which is pending before the Supreme Court, not before the tribunal, not before the High Courts, but if an identical matter is pending before the Supreme Court, then the Income Tax Department can tell you, when you have an issue on this provision, our appeal is, one matter is already pending before the Supreme Court, we will not trouble you just now, we will not file an appeal to the tribunal, so you'll have to fight right now. If you give your consent, we will not file an appeal right now, we will just make an application to the tribunal to keep this matter in abeyance. Let it remain there 1 year, 2 years, 3 years, 5 years. When the Supreme Court decides,